In 1934, Franklin D. Roosevelt signed a single piece of legislation in Washington. 12 months later, farmers starved in rural China. Businesses collapsed in Shanghai. The Chinese economy fell into a deflationary spiral so severe it destabilized an entire nation. Roosevelt never intended this outcome. He wanted to help American silver miners in Nevada and Montana. He wanted their votes. He got them. China got economic destruction. Your history teacher called this the Silver Purchase Act, a footnote in Depression-era policy, a minor detail in the New Deal. Here's the detail your teacher left out. The United States drained 500 million ounces of silver from China between 1934 and 1935. The Chinese monetary system operated on a silver standard. When America raised global silver prices by 128%, Chinese currency became worth more melted down and shipped to San Francisco than circulating in Shanghai. Chinese banks failed by the hundreds. The economy contracted by 26% in a single year. This was not a trade war. This was monetary annihilation executed through commodity policy. Now look at your screen in 2024. The Shanghai Gold Exchange prices silver at a 13% premium over London and New York. Chinese buyers pay more for physical silver than Western paper contracts suggest they should. Arbitrage traders cannot close the gap. The premium persists month after month. Western analysts call this an anomaly, a logistics problem, a temporary distortion. They are wrong. This is revenge. And it is 500 years in the making. The 13% Shanghai premium represents something the Western financial system has not confronted since 1571. Asian physical demand is creating a price your paper markets cannot match. Your futures contracts say silver is worth $23. Shanghai buyers hand over $26 and take delivery of real metal. One of these prices is a fiction. The market will decide which one. Silver did not become valuable because miners dug it from the ground. Silver became the most consequential metal in human history because China demanded it. For 5 centuries, Chinese silver demand bent the trajectory of empires. It created the first global trade network. It triggered the Opium Wars. It collapsed the nationalist government in the 1930s. And it is now exposing structural fractures in Western commodity markets. London bankers do not set silver prices. They manage the flow of silver prices. The difference matters. Gatekeepers control access. They do not control demand. When physical demand exceeds what gatekeepers provide, the entire infrastructure of price control enters crisis. You are watching this crisis form in real time. Welcome to Rashi Historical. We follow the money, trace the power, and expose the history they never taught you in school. The silver market today operates on 2 parallel tracks. Western exchanges trade paper contracts representing silver most buyers never intend to touch. Shanghai trades physical metal leaving the vault within days of purchase. These 2 systems now produce 2 prices. The gap between them tells you which market reflects reality and which market reflects institutional convenience. Your retirement account holds paper claims. Your government's monetary policy assumes paper prices equal physical prices. The Shanghai premium says this assumption is breaking down. 500 years of history explains why. The year was 1571. A Spanish galleon named San Pablo departed Acapulco harbor carrying 200,000 silver pesos. Its destination was Manila in the Philippine Islands. Its cargo would cross the Pacific, transfer to Chinese merchant junks, and disappear into the Middle Kingdom. The silver never returned to Spain, neither did the next shipment, or the shipment after. For 244 years, the Manila galleon trade operated as the largest wealth transfer in human history. Spanish colonial records from the Casa de Contratación in Seville document a one-way flow of 150 to 200 million pesos in silver moving from the Americas to China. Convert this to modern measurements. Between 4.5 and 6 billion ounces of silver crossed the Pacific and stayed in Chinese hands. Spain mined silver in Potosí, Bolivia. Workers hauled ore from tunnels at 15,000 feet elevation. Mules carried refined silver bars down the mountain to colonial mints in Lima and Mexico City. Ships transported the silver across the Atlantic to Seville, then overland to Acapulco. And there the silver exited the Spanish monetary system forever. China absorbed this metal and demanded more. Economic historians Dennis O. Flynn and Arturo Giraldez pinpoint 1571 as the birth of world trade. Their research in the Journal of World History traces the creation of the first integrated global economy to the opening of the Manila route. Before 1571, regional trade networks existed in isolation. After 1571, a single commodity linked 4 continents into one economic system. Silver was the commodity. China was the destination. Everything else was infrastructure. The Ming Dynasty operated on a silver-based taxation system called the Single Whip Reform. Peasants paid taxes in silver rather than grain or labor. Merchants settled accounts in silver. The imperial treasury measured its reserves in silver taels. This policy created structural demand for silver exceeding domestic supply by an order of magnitude. Chinese mines produced approximately 30 million ounces of silver annually during the late Ming period. Chinese demand consumed more than 100 million ounces annually. The deficit had to come from somewhere. Spanish America provided the supply. Chinese demand provided the incentive. The Manila galleons provided the logistics. European mercantilist economists went insane trying to understand the imbalance. Their models assumed national wealth accumulated through trade surpluses. Spain ran permanent deficits with China and grew richer. China ran permanent surpluses and demanded more silver anyway. The models broke down because they measured the wrong variable. Spain did not trade with China. Spain extracted silver from American colonies and delivered it to the one market willing to pay premium prices. The Chinese silver price consistently exceeded European silver prices by 50 to 100% throughout the 16th and 17th centuries. Arbitrage profits made the 10,000-mile voyage profitable, despite storms, pirates, and shipwrecks. Here is what the Spanish court never understood. They believed they controlled the silver. They mined it. They minted it. They shipped it. They set the exchange rates in Seville. None of this mattered. China controlled the demand. And demand, at sufficient scale, controls everything upstream. Spain operated a logistics network serving Chinese monetary requirements. The Spanish Empire believed it ran a colonial extraction system. In practice, Spain functioned as a mining contractor for Chinese commerce. This distinction between control and logistics defines the silver story for 5 centuries. The flow of silver into China produced consequences the Spanish crown never anticipated. Chinese merchants accumulated silver hoards their government could not track. Private wealth concentrated outside state channels. Regional economic power shifted away from the imperial court. When the Ming dynasty collapsed in 1644, silver concentration among coastal merchants had already undermined central fiscal authority. The Qing dynasty inherited the system and amplified it. Chinese silver demand in the 18th century exceeded Ming dynasty levels by 40%. The Manila galleons continued their annual crossings until 1815. Each voyage drained more silver from European circulation. European powers tried to find alternatives. The Dutch East India Company searched for commodities China would accept in exchange for silk and tea. They found none in sufficient quantity. The British East India Company faced the same problem. China wanted silver. China would accept nothing else at scale. This created the pressure point European empires would later exploit with catastrophic violence. The Manila galleon era established a pattern. Chinese silver demand functioned as a structural feature of the global economy. Western powers could supply this demand at profit, or watch their competitors supply it instead. No Western policy could eliminate the demand. No Western technology could substitute for silver in Chinese commerce. Asian physical demand dictated Western commercial strategy for 250 years. Remember this pattern. You will see it again. By 1800, the British Empire faced a balance of payments crisis it could not solve through conventional trade. British consumers demanded Chinese tea. British merchants demanded Chinese silk. British industry demanded Chinese porcelain. Payment for these goods required silver, and British silver reserves were draining eastward at rates the Treasury found alarming. Parliamentary records from the 1830s document the scale of the problem. Britain imported $20 million in Chinese goods annually, while exporting less than $6 million in British manufactured goods to China. The difference left the country as silver bullion. British textile mills produced the finest cloth in the world. Chinese consumers did not want it. British ironworks produced superior tools and machinery. Chinese craftsmen preferred traditional methods. British naval supremacy controlled sea lanes across the globe. Chinese coastal authorities refused to open additional ports. The Qing dynasty restricted foreign trade to a single city, Canton. 13 licensed merchant houses called the Kohong held monopoly rights over all foreign commerce. British traders negotiated with these merchants or returned home empty. Lord Palmerston's correspondence describes the frustration in explicit terms. British commercial interests could not penetrate Chinese markets through normal means. The Canton system bottlenecked all trade through a single pressure point controlled by Chinese gatekeepers. The East India Company found the solution in Bengal. British colonial administrators in India oversaw opium poppy cultivation across the Ganges River Valley. Indian farmers grew the poppies. Indian laborers processed raw opium into transportable cakes. British merchant ships carried the product to Linton Island outside Canton Harbor. The legal fiction worked like this. The East India Company auctioned opium in Calcutta to nominally independent merchants called country traders. These traders transported opium to China and sold it to smuggling networks operating under Qing prohibition. Silver payments flowed from Chinese opium consumers to country traders to East India Company auctions to British imperial revenue. The triangular trade solved the silver drain. By 1836, the flow reversed entirely. Silver now drained from China to British India at rates matching the earlier outflow to China. Parliamentary testimony from the period shows British officials understood what they were doing. They engineered a system to extract Chinese silver through mass addiction. The opium trade was not a market response to consumer demand. It was a monetary weapon designed to reverse a balance of payments China had maintained for 3 centuries. Commissioner Lin Zexu saw the threat clearly. His memorial to Queen Victoria in 1839 laid out the case. British merchants poisoned Chinese subjects for profit. British silver extraction destroyed the Chinese monetary base. Continued tolerance meant economic collapse. Lin confiscated and destroyed 1.2 million kilograms of British opium at Canton in June 1839. He expelled British merchants from the city. He closed the port to British trade. Lord Palmerston ordered the Royal Navy to respond. The First Opium War lasted from 1839 to 1842. British steam warships destroyed Chinese coastal defenses with industrial efficiency. The Treaty of Nanking forced China to cede Hong Kong Island, open 5 treaty ports to British trade, and pay 21 million silver dollars in indemnities. The treaty did not mention opium. It did not need to. British merchants resumed opium sales the moment the guns fell silent. The silver drain accelerated through the 1850s and 1860s. A second war in 1856 extracted additional concessions. Here's what the official narrative obscures. Britain did not fight the Opium Wars for trading rights. Britain fought the Opium Wars to break Chinese control over silver flows. For 300 years, China had functioned as the terminal destination for global silver. The Qing dynasty taxed foreign trade through the Canton system and accumulated monetary reserves European powers found intolerable. Opium reversed the flow. Military force kept it reversed. The British Empire did not sell drugs to China because British merchants lacked morality. The British Empire sold drugs to China because no other product in sufficient quantity could extract silver from Chinese circulation. Tea and silk went west. Opium and silver went east to British India. The triangle closed through Calcutta. This was extraction machinery engineered at imperial scale. The consequences for China lasted a century. Silver outflows created deflation. Deflation destroyed rural economies dependent on stable currency values. Peasant revolts spread across southern provinces. The Taiping Rebellion killed 20 million people between 1850 and 1864. The Qing dynasty never recovered its legitimacy. Western historians call the period from 1839 to 1949 the century of humiliation. The term appears in Chinese textbooks today. Every Chinese student learns what happened when Western powers seized control of Chinese commerce. This memory shapes Chinese policy in 2024. Franklin Roosevelt never intended to collapse the Chinese economy. He intended to win votes in Western states where silver miners faced Depression-era unemployment. The political math was straightforward. Silver-producing states held Senate seats Roosevelt needed for New Deal legislation. Silver miners demanded federal price supports. Silver state senators demanded action before approving Roosevelt's domestic programs. The Silver Purchase Act of June 1934 authorized the U.S. Treasury to buy silver until the metal constituted 1/4 of monetary reserves. This policy raised the domestic silver price from 45 cents per ounce to over $1 per ounce within 12 months. Treasury records from the period show administrative officials understood international consequences were possible. They did not understand the scale. China in 1934 operated on a silver standard. Unlike Europe and America, which had abandoned gold backing during the Depression, China maintained full silver convertibility of its currency. Chinese dollars contained a fixed weight of silver. Any holder could exchange currency for metal at any bank. When the United States raised global silver prices, it raised the value of Chinese currency relative to all other currencies. This sounds beneficial. It was catastrophic. A stronger currency meant Chinese exports cost more in foreign markets. Foreign buyers purchased less. Export industries collapsed. Unemployment spread through coastal manufacturing centers. A stronger currency also meant silver in China was worth less than silver in America. Arbitrage traders melted Chinese coins and shipped the metal to San Francisco. Federal Reserve Bank of New York correspondence documents the scale of inflows. 500 million ounces of Chinese silver crossed the Pacific between 1934 and 1935. Chinese banks held silver reserves against deposits. When the silver left the country, banks could not honor withdrawals. Bank failures cascaded through the financial system. Credit froze. Businesses could not make payroll. Industrial production fell 26% in a single year. Milton Friedman documented these consequences in his analysis of Depression-era monetary policy. He called the Silver Purchase Act one of the most destructive pieces of economic legislation in American history, not because of its domestic effects, which were modest, but because of its international effects, which were devastating. The Roosevelt administration received warnings from China. The nationalist government of Chiang Kai-shek sent diplomatic communications explaining the damage. American silver policy was destroying a friendly nation's economy. Washington did not change course. Silver state senators mattered more than Chinese stability. By November 1935, China abandoned the silver standard. The nationalist government nationalized all silver holdings and transitioned to a managed paper currency called the Fabi. This removed Chinese demand from global silver markets overnight. The transition solved the immediate crisis. It created longer-term problems Roosevelt's advisors never anticipated. The Fabi required foreign exchange reserves to maintain value. Chiang Kai-shek's government depended on British and American support to defend the currency. When Japan invaded eastern China in 1937, this support became conditional on political compliance. Wartime inflation destroyed the Fabi's purchasing power by 1948. The communist victory in 1949 followed economic collapse as much as military defeat. Trace the causation chain. American silver policy in 1934 forced China off the silver standard. Abandoning silver created dependence on foreign currency reserves. Foreign reserve dependence created political vulnerability during wartime. Political vulnerability contributed to nationalist defeat. Roosevelt wanted votes from Nevada and Montana. He got them. China got monetary destruction, economic collapse, and political revolution. This history lives in institutional memory. When Chinese policymakers discuss Western commodity markets today, they reference 1934. When Shanghai Gold Exchange officials explain why China needs independent price discovery, they cite the Silver Purchase Act. When Chinese central bankers accumulate gold reserves rather than dollar holdings, they remember what happens when American domestic politics target Chinese monetary systems. The 13% Shanghai silver premium is not a logistics problem. It is a policy response to demonstrated historical risk. The Shanghai Gold Exchange opened for trading on October 30th, 2002. Western analysts paid minimal attention. Gold trading in Shanghai seemed irrelevant to London and New York price discovery. This assessment reflected a failure to understand Chinese strategic planning. Chinese officials studied commodity markets for 2 decades before launching the SGE. They mapped control points in Western systems. They identified how London bullion banks managed gold and silver pricing through paper contracts rather than physical delivery. They observed that Western exchanges traded hundreds of times more metal on paper than existed in their vaults. The SGE launched with a different model. Physical delivery, real metal. Every contract settling in bars, leaving the vault. Annual reports from the SGE document the structural difference. In London, less than 1% of futures contracts result in physical delivery. Traders roll positions forward indefinitely, never taking metal. In Shanghai, delivery rates exceed 30%. Chinese buyers want the silver. They take it. This creates a different relationship between paper price and physical reality. Western exchanges function as price-setting mechanisms for industrial consumers and financial speculators. Physical delivery exists, but remains the exception. Most participants trade exposure to price movements rather than metal itself. Shanghai functions as a physical distribution mechanism. Price discovery happens, but acquisition drives participation. Chinese industrial consumers buy silver because their factories need silver. Chinese retail investors buy silver because they want silver in their possession. The difference matters when supply tightens. Western paper markets can satisfy unlimited demand through contract issuance. Want to buy 1 million ounces of silver exposure? No problem. The exchange creates a new contract and matches you with a seller. Neither party intends to move metal. The trade clears in cash at contract expiration. Shanghai cannot satisfy demand through paper issuance. Want to buy 1 million ounces of silver? The exchange needs 1 million ounces in the vault. If the vault runs short, buyers wait. Or buyers pay a premium to jump the queue. State Administration of Foreign Exchange data shows Chinese silver imports rising steadily from 2002 through 2020. Industrial demand from solar panel manufacturing drove early growth. Investment demand from retail buyers amplified the trend after 2015. By 2020, Chinese silver imports exceeded 150 million ounces annually. This demand required physical supply the Western delivery system strained to provide. The London Bullion Market Association operates the primary Western silver price benchmark. LBMA member banks set the daily silver fix through electronic auction. Prices discovered in London propagate through futures markets in New York and Chicago. Here is the structural issue. LBMA pricing assumes Western delivery mechanisms can satisfy demand at the fixing price. When Chinese buyers take 150 million ounces of physical supply, they reduce metal available for Western delivery. The fixed price reflects available supply. Chinese demand reduces that supply. Arbitrage should close any gap. If Shanghai prices exceed London prices, traders buy in London, ship to Shanghai, and pocket the difference. Simple logistics. Except simple logistics require available supply. When London vaults run lean, arbitrage cannot function. Traders cannot buy metal that does not exist. They can buy paper contracts promising future delivery, but paper contracts do not satisfy Shanghai buyers who want physical bars. The premium appears when physical demand exceeds physical supply, and paper mechanisms cannot bridge the gap. In March 2020, silver prices collapsed alongside global equity markets. Western paper contracts drove pricing as leveraged traders liquidated positions. The COMEX silver price fell below $12 per ounce. Physical silver vanished from dealer inventories within days. Retail buyers attempted purchases and found nothing available. Premiums at coin dealers exceeded 50% above spot price. The paper price said $12. The physical price said $18. This disconnect exposed a structural vulnerability Western markets had concealed for decades. Paper prices and physical prices diverged because the markets serve different functions. Paper markets provide liquidity for speculative positioning. Physical markets provide metal for end users. When both function normally, arbitrage keeps prices aligned. When stress appears, the systems decouple. March 2020 was temporary. By May, physical premiums normalized as demand subsided and supply chains recovered. The Shanghai premium is not temporary. Exchange data shows the gap emerging in late 2021 and persisting through 2024. Shanghai silver prices consistently exceed Western benchmark prices by 8 to 15%. The premium fluctuates but never closes. Arbitrage has not eliminated it. Market forces have not equalized it. 3 explanations exist for a persistent premium. First explanation, logistics bottlenecks. Shipping silver from London to Shanghai takes time and costs money. Transport costs and delivery delays could justify a modest premium. Analysis, transport costs explain a 2 to 3% premium, not a 13% premium. Logistics cannot account for the full gap. Second explanation, tariffs and regulations. Chinese import duties and administrative requirements could inflate Shanghai prices. Analysis. Silver imports carry a 17% VAT, but this applies to all imported silver and creates a consistent cost rather than a variable premium. Regulatory costs do not explain premium fluctuation. Third explanation. Structural supply failure. Western delivery mechanisms cannot provide sufficient physical metal to satisfy Chinese demand at Western prices. Shanghai buyers bid prices up because they cannot acquire metal at London prices. The premium reflects a two-tier market where paper and physical have diverged. The evidence supports the third explanation. LBMA vault data shows declining silver inventory since 2021. COMEX registered silver stocks fell by 70% between 2021 and 2023. Western exchanges maintain less deliverable silver than at any point in the past decade. Meanwhile, Chinese demand accelerated. Solar panel production consumes silver for photovoltaic cells. China manufactures 80% of global solar panels. Each gigawatt of solar capacity requires approximately 1 million ounces of silver. Chinese solar installations exceeded 200 gigawatts in 2023 alone. Electric vehicle production consumes silver for electrical contacts and battery connections. China manufactures 60% of global electric vehicles. Each vehicle requires 1 to 2 ounces of silver. Electronics manufacturing consumes silver for circuit boards, switches, and conductors. China dominates global electronics assembly. Every smartphone, computer, and appliance contains silver components. Industrial demand from Chinese manufacturing exceeds what Western delivery systems can supply at current prices. The premium signals this shortage. Investment demand amplifies the pressure. Chinese retail investors accumulated silver through SGE-linked products after 2020. Real estate market stress redirected savings toward precious metals. The Chinese government encouraged gold and silver accumulation as alternatives to property speculation. These buyers want physical possession. They distrust paper claims after decades of wealth management product failures. They take delivery, they store metal, they remove supply from circulation. The 13% premium represents their collective demand overwhelming Western supply mechanisms. Now consider what happens if the premium persists. Western industrial consumers face a choice: pay London prices and hope metal arrives, or pay Shanghai prices and guarantee delivery. As supply tightens, more buyers will pay the premium. The premium becomes the price. Western futures markets face a credibility problem. If paper prices diverge from physical prices permanently, what do paper contracts represent? Financial exposure to a fictional commodity price has limited utility. Industrial buyers need metal, not exposure. Western monetary authorities face a policy problem. Silver price movements propagate through industrial supply chains. Higher silver prices increase solar panel costs, electric vehicle costs, and electronics costs. These costs appear in inflation data. Central banks cannot ignore commodity prices that diverge from their models. China faces opportunity. If Shanghai price discovery becomes the global benchmark, Chinese institutions gain leverage over a strategic industrial metal. Chinese policy can influence global silver prices through SGE trading rules, import regulations, and reserve accumulation. Chinese strategic reserves can buffer domestic industry from price volatility while foreign competitors absorb the shocks. This is what 500 years of silver history produces. China demanded silver when Spain controlled the mines. Spain delivered. China demanded silver when Britain controlled the seas. Britain found opium to reverse the flow. China demanded silver when America controlled the price. America destroyed China's economy for domestic political convenience. In 2024, China controls the demand and the delivery mechanism. Shanghai sets a price reflecting physical reality. Western markets set a price reflecting paper liquidity. The gap between them measures how badly Western systems underestimate Chinese structural power. The next 12 months will determine which price wins. If Western prices rise to meet Shanghai, every silver holder gains. Your mining stocks rise, your silver coins appreciate, your exposure to precious metals pays off. If Western prices refuse to rise, the paper system loses credibility. Futures contracts become untethered from physical value. The London fix becomes irrelevant to actual metal transactions. Price discovery migrates to Shanghai permanently. Either outcome represents a transfer of power from west to east, from paper to physical, from financialized abstraction to material reality. 500 years of silver history suggests the transfer is overdue. The Spanish Empire learned that controlling supply does not mean controlling markets. The British Empire learned that reversing flows requires violence. The American government learned that domestic political convenience creates international destruction. Now, Western commodity markets will learn what Chinese policymakers already know. Physical demand, at sufficient scale, is untouchable. You cannot print silver. You cannot legislate silver into existence. You cannot issue paper contracts until industrial consumers accept paper instead of metal. You can only supply the demand, or lose the market to someone who will. Shanghai will supply the demand. Shanghai will set the price. Shanghai will complete a cycle that began when the first galleon crossed the Pacific with a hold full of Potosí silver. The 13% premium is the market telling you the story. Whether Western institutions listen determines whether the transition happens smoothly or through crisis. History suggests crisis is more likely. Conclusion. Your understanding of silver markets is about to prove its value. The Shanghai premium is not financial trivia. It signals a structural shift in who controls pricing for industrial metals essential to global manufacturing. Solar panels, electric vehicles, electronics, medical devices, and water purification systems all require silver. Whoever controls silver pricing influences production costs for industries defining the 21st century economy. For 50 years, Western financial institutions controlled this pricing through paper contract mechanisms. London set the benchmark. New York provided liquidity. Asian industrial consumers accepted prices set in Western trading hours by Western institutions. The 13% Shanghai premium says this arrangement is ending. You now possess context most market analysts lack. You understand why Chinese demand for silver operates differently than demand for other commodities. You understand the historical precedents for Asian physical demand disrupting Western monetary systems. You understand why 1571, 1839, and 1934 matter for 2024. This knowledge has practical application. If you hold silver investments, understand that Western paper prices may understate physical value. The premium tells you physical buyers pay more than paper traders think metal is worth. Physical holdings may prove more valuable than paper exposure as the systems diverge. If you follow monetary policy, understand that silver supply constraints will affect industrial costs in sectors governments prioritize for green energy transitions. Price pressures will appear in inflation data. Central bank models, assuming stable commodity prices, will need revision. If you assess geopolitical risk, understand that commodity pricing power is strategic leverage. Chinese control over silver price discovery would parallel Chinese dominance in rare earth processing. Western dependence on Chinese industrial supply chains extends to the pricing of metals those supply chains consume. The history is clear. The precedents are documented. The current data confirms the pattern. Shanghai is completing what Manila began in 1571. Asian silver demand will determine global silver prices. Western institutions can accept this reality and adapt, or they can deny it and lose relevance. The metal will flow where the demand is. The price will form where the delivery is. For 500 years, this has been true. The next chapter of silver history is being written now in Shanghai. In physical bars, leaving SGE vaults for Chinese industrial facilities and private storage. You know the story. Now watch it unfold.